A very good afternoon. Welcome to the markets. Asian markets were mostly up today. One possible driver may have been Chinese authorities announcing a raft of stimulus measures, including interest rate cuts taking effect on the 8th of May and a major liquidity injection. This as Beijing steps up efforts to soften the economic damage resulting from the trade war between itself and the United States. The announcements come shortly after US and Chinese officials said Treasury Secretary Scott Bessent and Chief Trade Negotiator Jamieson Greer would be meeting China's top economic official in Switzerland for talks this weekend. The Nikkei share average declined by 0.14%. The Hang Seng Index closed up 0.13%, while the Shanghai Composite Index ended the session up 0.8%. US stock markets ended the session lower yesterday. This as investor sentiment was shaken by the US administration's contradictory statements and positions on trade talks. Between the Treasury Secretary and Donald Trump, it seems market players were not able to get a sense of clarity on the timeline for any trade deals. Meanwhile, market players are awaiting the US Fed Reserve's call on interest rates later this evening, with investors currently pricing in a no change in rates position. The Dow Jones Industrial Average declined by 0.95%. The S&P 500 lost 0.8%, while the Nasdaq Composite Index closed down 0.87%. All right, looking at our local indicators, the all-share index is currently 0.2% weaker at 91,859 index points. On the currency front, we see that the rand is trading at 18.29 vis-a-vis the US dollar, 20.78 against the euro, and 24.40 against the British pound. On the commodity front, gold is trading at $3,389 an ounce, platinum at $983 an ounce, while Brent crude oil is trading at $62.37 a barrel. All right, let's get into the markets with Chantel Marks. She's the head of equity research at F&B Wealth and Investments. Chantel, thanks very much for joining us as always. So it now seems that a trade meeting is going to take place between the US and China over the weekend, which is positive. But there's been quite a lot of confusion around the timeline for trade talks, not just between the two largest economies in the world, but also between the US and other countries as well.
Yes, of course, the 90-day period is no longer a 90-day period. So there is a lot that needs to be done before it lapses. And from a US-China perspective, there's also a lot that still needs to be done. From what we understand, the Chinese have insisted on following kind of diplomatic protocol on these talks. So the meeting that we're expecting this weekend is actually going to be a meeting about a meeting. That tells me that it could take quite some time before we get to a resolution on the standoff.
So much of the focus today will be on the US Fed. The markets are expecting no change on rates, but what are you expecting the chairman's speech to focus on?
I think the speech is going to highlight just how uncertain the environment is currently. It's an uncertain policy environment, and the outlook, I think, from an inflation and employment perspective, which is basically the mandate of the Fed to manage, has really become a lot less uncertain. And I think it's become in conflict with one another. So the inflation outlook, while uncertain, looks to be pointing towards a pickup in inflation, and the jobs outlook is souring. So what does the Fed do in a scenario where inflation is high and job growth is under pressure? Because if they cut rates in a scenario like that, you could see the inflation situation spiral. And if they hike rates in a situation like that, you could see a further and more deep deterioration in the employment market in the US.
Yeah, that's what you call being between a rock and a hard place. So Moody's, they came out with its global economic outlook report yesterday afternoon. They cut growth for key G20 countries as well as South Africa to 1.5% from 1.7%. But of course, the IMF signaled growth of about 0.81% for South Africa this year. And of course, Budget 3.0 is around the corner. One would expect that National Treasury will have to bring down its forecast right down, because I think at the Budget 2.0, they were forecasting 1.9%. And of course, that has implications for what revenue expectations will be as well.
Yes, absolutely. So they will have to adjust their growth forecast for this year. I think that when we looked at budget 1.0, we were not even in a scenario where we were talking about the kinds of tariffs and the kinds of kind of the policies being implemented by the US that has really unnerved global markets and has possibly resulted in a derailing of global growth. So things have changed. They'll have to adjust to that. I think from a tax revenue perspective, obviously lowering your growth forecast will have an impact on expected tax receipts. So far this year, though, tax receipts have held up reasonably well. So perhaps that gives them hope that the path through from lower growth won't necessarily be as severe on the fiscus as one might expect under normal conditions.
Yeah. Well, we know, you've said it already, that there's a lot of uncertainty around the tariffs and discussions between the US and China and US vis-a-vis other countries. But we know that gold has had a really good run, but it's weakened in recent sessions. And tied to that, DRD Gold put out a statement indicating an increase in revenue of 4% for the quarter ended March this year. And this was on the back of the higher gold price. But unfortunately, it doesn't look like they were able to produce as much as they would have liked, given the higher price of gold. So a quick comment on the underlying commodity itself, gold, and the company.
Yes, so I think that gold is actually being well supported by the uncertainty that we're seeing currently, and you'll have some volatility around that as we get news, positive news on trade tensions being resolved, and then you'll probably get the gold price being kind of coming back whenever there's negative news surrounding the trade scenario or any other crazy policy shifts out of the US. So I think that for now it's well supported because we're still in that very uncertain environment. But I think the upside might be capped. We've had a spectacular run in the gold price so far. So what this means for a producer like DRD Gold is that they need to do well right now while the gold price is high, and really to kind of capture those gains while the gold price is so high and production cost is quite low. I think what happened with them in this specific quarter was the weather. We know that we've had unseasonably wet weather across South Africa, particularly in Gauteng, over the last few months, and that's really had an impact on their ability to actually produce gold. So that's something that we saw out of Harmony as well. We would expect that to improve in the next quarter, and we would expect the gold price to still be relatively high in the next quarter and probably in the next few quarters beyond that. So they'll make it up. Unfortunate just that this quarter was very, very wet.
Indeed. Thank you so much, Chantel, for your time and your insights. As always, that was Chantel Marks. She's the head of equity research at F&B Wealth and Investments. After a quick break, Juliet will have more news for you. See you tomorrow.